I want to talk a little bit about kind of some current events. So maybe let's start with public markets. We have seen all kinds of chaos transpire. I know you're an investor in public.com, a couple other companies, but just like zoom out a little bit and help me understand kind of your views on what's going on in the public markets, the whole Wall Street bets and Reddit, and kind of anything in that whole arena.
Yeah, just so maybe to zoom out a little bit. I mean, just to start off with, I guess, my own portfolio. So I manage, there's two strategies that I have in the public markets that fit the way that I think about the world really neatly and that I really enjoy. And I have one called Future Shape, which is largely making kind of ARK style bets. ARK, for anyone that doesn't know, I'm talking about ARK Invest, which has the ETF ARKK and largely invests in kind of next generation disruptive technologies. And the idea there is just, I think generationally, we are in a time where we're seeing companies that are going to be the biggest players in the next 10 years begin to go public. They're obviously going public at very high valuations, but we are seeing, I think, a step function change in the markets. And part of my kind of thesis, which I know a lot of other people are of a similar mind, is so I first started out focusing much more on the venture capital side. And one of the aha moments for me was, okay, well, if I do this in a pretty industry agnostic way, and if I try to do this in part for research for what's coming next to the public markets, I have a really interesting look into what's going on, what the competitive landscape looks like. And that's true even for take something like Coinbase or like crypto. Like if you're an investor in Coinbase, you're going to have a much better, much more clearly articulated point of view about what that looks like as a public business if you invested in a private. And there's nothing shocking about that. So I do that piece. And then the other portfolio that I manage is totally different. And it's called the Perpetuity Fund. And what I invest in there is almost the polar opposite end of the spectrum, which is closely family held businesses that have been in business for an incredibly long time. So an example of that would be something like LVMH, which owns Louis Vuitton. It's a huge brand. It's run by one man who's on a tear. He owns a significant portion of the business. It's not going anywhere. Owning a luxury business is an incredible thing. So I'll stop there and kind of transition. And one thing that has been just fascinating for me is those portfolios collectively are up 30% in January, which is outrageous. No, most people would, close out a year at 30% and be like, oh my God, that had the best year of my life. And here we are at the end of January and up 30%. So clearly things aren't making sense. And clearly the valuations, and I said to a friend the other day, I'm like, I really believe in the businesses I'm invested in, but I know that there's no reason they should be trading at the valuations that they're at. And here's where it gets really interesting is, I read a book recently, by George Soros, which if anyone's interested, he has a super thin book that's all about his concept of reflexivity, which I think we're seeing play out a ton today, which is just the idea that, if you take the efficient market thesis and the idea that all businesses are always valued at exactly where they should be valued because the market's this magical thing that finds this perfect equilibrium. That's not true because humans at the end of the day are investing, and there's a shitload of different style investors as we're seeing today. There's Wall Street boys, there's endowments, there's pension funds, there's kind of people managing for retirement. So there's a bunch of different actors kind of in the markets doing different things. And reflexivity is just the idea that if the price goes up on an asset, that starts to become self-fulfilling at a certain point, and people then believe that it's worth this amount, which then feeds, and we're seeing that I would say in crypto, we're seeing that in things like GameStop. We're seeing that in a ton, even just, seeing Airbnb and DoorDash and how they're valued now post IPO. We have effectively jumped 5 years into the future in their business, and that's what the stock's trading at today. So it's an incredible time.
When you think about that, is that healthy? Like, do you think it's like, hey, it's going to correct in the future? Or do you think it's just, no, we live in a different world now, and yeah, sure, they're overvalued businesses, but that's almost like the new normal and it'll persist?
I don't think it's unhealthy at all. And I really disagree. I follow a lot of really smart investors on Twitter, and generally, I think they fall into two buckets of this kind of question. And one is the market's going to do what it's going to do, and if something's overvalued today, that doesn't mean that it's going to correct in 6 months. It doesn't mean it's going to correct in 2 years. And you have no idea when that correction is going to happen. I think as an investor, you always want to be aware of how closely you feel like the price is tethered to the reality of that business. But I think what we're seeing is also, again, part of my thesis behind that kind of future shape fund and investing in this next generation of disruptive technology is these are companies that our generation sees as their companies, and they want to own them in their portfolio. They want to own them in size. And, if they look at Square or they look at DoorDash or they look at, Airbnb, I don't think they're going to quibble with the valuation. I think they're like, this is a great business. I believe in it. It's not going anywhere. So I think it's just, in my mind, I think net, it's always better to try to just be a student of the times. And if things are, so as an example, I'll give you a practical example. So I said my portfolio is up 30% in January. I think for a lot of investors, they would say, well, let's just go ahead and start closing out those positions, or let's go all the way into cash. And I know a lot of people that are all in cash, but in my mind, I feel like, well, why would you do that? Why wouldn't you set stop orders yet, 10% underneath the current price, let it continue to ride up, maybe take money off the table as it goes up. But, if you're a proficient trader, you can effectively limit your downside risk and continue to enjoy the upside gains. And I just feel like today, for anyone who's in a fully cash position, I'm just like, you're certainly missing a really incredible window of time. And if you're in a cash position now, you could be in that cash position 2 years from now. Because I think, yes, we're at historic highs, but that's not to say it's not going to go higher.